Thank you, Christina. Joining us now to talk all things economy, financial markets analyst and author of Planet Ponzi, Mitch Firestein, as well as economic strategist Francis Newton. Pleasure to have you both here. Mitch, going to start with you. Going to start with inflation, 2.4%. That is what has come out here. So how are you reading that? It's staying the same?
It's very benign, that number. So it gives the Federal Reserve no excuse not to cut interest rates, which it needs to do, because the employment numbers were a bit on the grim side. I didn't really see much positive in those numbers that came out. And I think that the mandate the Federal Reserve has is dual mandate, full employment and price stability. And we don't, we're having issues with the employment market right now. So I think that they need to lower interest rates to get the 10-year bond trading back below 4% so that the housing market can ease up a bit and people can have more affordable housing.
You're kind of nagging, Francis. I know the goal, obviously, 2%, much better than under the previous administration, the Biden administration, but still sitting at 2.4, how that's impacting, everyday prices for Americans. And this is, kind of being prolonged at this point. So how it impacts everyone.
Yeah, the thing about it is that, even the prices haven't returned to where they were from when inflation was accelerating at a rate of 9%. So now it's accelerating at a lower percentage rate, but it's still moving higher. We haven't seen any deflation. So prices are not going down. So that's just become very accumulative for consumers since the pandemic. And not only that, their grocery prices have gone up exponentially, but so have their credit card interest rates. And that's one of the big issues with rates that we have to lower. And of course, we have recent events in the markets where rates are spiking. So we'll just have to see if rates remain elevated or when the volatility passes, they go back down.
Now, Mitch, Francis just mentioned deflation here, and I think that some Americans, a lot of Americans, that's what they want to see, actually prices falling from where they are. And I know that's incredibly hard to have happen for businesses to start lowering prices. The margins, they all change here. Can you explain that?
Well, look, I think that what Francis brought up was exactly right. The cumulative inflation was something, if you look at it, was somewhere between 27 and 33%.
It was a disaster.
Yeah, 27 and 33%. So that's got to come down or wages have to go higher. Deflation might be a little bit difficult. I don't think it depends upon exactly what sector you're talking in that you expect the pricing to come down. I do think, however, that right now what we're seeing in the 10-year bond yields is going to be a very good buy. So if people, I think, shifting some of their asset allocation from the stock market into the 10-year note would be really good value for them, because I think any pickup above 4.20%, you're going to do fairly well, because the Fed is going to have no other option but to cut between 75 and 100 basis points this year, because there are a lot of other credit issues going on in the market.
Let's switch gears, Francis. Oil, the prices, they've been up, they've been down, kind of all over the place. Americans are worried about paying at the pump, other expenses. I get that. I'm fully aware of that. So your message to them would be what, as the conflict in Iran, it continues, and we know the Strait of Hormuz closed down?
Well, this is the thing that Americans have to keep in mind, is that Trump is playing with a very large, very long-term chessboard. And what most people don't realize is that everything economic is mechanical. So this oil situation in Iran is going to affect how China gets energy. What Trump is trying to do is increase leverage against China, because Trump is trying to keep the U.S. at 26% of the world's GDP, with China only having 17% of the world's GDP. And so that's what's really going on with these larger plays in oil. Now, we did have a lot of short-term volatility, which caused rates to spike, which the Fed is going to have to address when they have their next meeting. And that is the kryptonite for Trump, whether it was Liberation Day or whether it's rate spiking here, because as Mitch alluded to, there are some credit issues. And so that's the thing, that's the needle that needs to be thread. But hopefully this volatility calms down, and hopefully it doesn't leave too big of an imprint in the next CPI print.
Let's hope not. And it is a game of chess, not checkers, Francis, as you are so poignantly making us aware of that. Mitch, Francis, it's a pleasure. Appreciate you both coming on. Thank you.